If you're a small business owner and you plan to retire one day, or you're in the investment industry or are a financial planner, today's video is especially important for you. Stay tuned.
I'm David C. Barnett, and you're tuned in to Small Business and Deal Making, the podcast, YouTube channel, and blog where I talk about buying, selling, financing, and managing small and medium sized businesses while controlling risk. So, if you're looking to take control of your future through buying a business one day, or if you already own a business and you're looking to grow or exit, you've come to the right place. I talk about interesting things, I talk to interesting people, and I answer your questions every week right here. So, be sure to hit like and be sure to hit subscribe, and let's get to it. Are you thinking of growing your business or beginning a journey into entrepreneurship? Take a shortcut to success by buying an existing and profitable business the right way. Visit businessbuyeradvantage.com and learn more about my online training, group coaching, and consulting services designed to help you win.
All right, everyone. I had a telephone conversation the other day with a financial planner, and about halfway through the conversation, I realized that I've had the same conversation with about 10 other financial planners over the course of my career. And I thought, hey, I should make a video about this. So that's what we're doing today. So what am I going to be talking about? Here's the thing. Business owners are people, and they as they get older, they begin to realize, hey, I'm headed towards retirement, and I'm going to need money when I'm retired. And so eventually they'll reach a point where they start to get serious and they say, hey, I need some kind of retirement plan. And either they'll go looking for someone to help them with that, and they'll find an investment advisor of some kind, a financial planner, or someone will come knocking on their door, right? And they'll begin engaging with a financial planner. And so they start to accumulate money, they create a plan. What then happens? Well, the financial planner is asking questions like, what kind of lifestyle you're going to have when you retire? What are your plans? What do you want to do, etc. And the financial planner starts to build a plan, right? And there's all kinds of assumptions that go into that plan. All kinds of assumptions, from the rate of interest to the annual return that's going to be able to be obtained through different investments that they might, put the money into, etc. And in almost every one of these conversations, there is a huge hole in the plan that almost everyone doesn't notice until the 11th hour, right? So, what is that huge hole in the plan? It's the value of the business. So, let me give you a common scenario. Investment advisor meets with a business owner, and the business owner maybe is in their 30s. And the advisor asks them all the questions about what it's going to look like in their retirement, and the business owner answers to the best of their ability. Maybe it's a married couple and they're answering these questions with the financial planner. The financial planner comes up with some goal, some amount of value that needs to be accumulated through the investments over the years that's going to be able to then yield the lifestyle that the retiring parties want. And one of the questions that will probably come up in that conversation is, are you going to sell the business as part of this plan, right? And if the business owner says, yeah, I'm going to sell the business, the next question is, well, what will it sell for? And a number is introduced into the equation. And this number often gets put into the financial plan, right? So why did this come up in a conversation I was having the other day? Well, somebody found me through LinkedIn, and they were a financial planner, and their client is trying to sell their business, a business that they bought about a dozen years ago. And so this business has had a lot of ups and downs over the course of time that the current owner has had it. And they happen to sell a product, which is a highly discretionary home product, which did very well during the pandemic years, 2021, 22. Okay. And now that whole industry is in decline because the product they sell is not as popular. Sorry, I can't be more specific. So here's the issue is the business is now up for sale, and the business has been up for sale for about a year and a half, and the business broker they're working with put a price on it. And because of what's happening with revenue and profitability, as each buyer that successfully makes an offer gets into due diligence, they begin to see the trends and they're pulling out. They don't want to buy it, or they're coming back with amended offers that are at a much lower price. The broker is trying to sell the business right now for a price which approximates the inventory value, because honestly, the cash flow of the business warrants that kind of price. So they're essentially down to liquidation right now. But here's the problem. Um, Back when it was bought, there was a document created saying that the business was worth about $2 million. So in the financial plan, it says that there's going to be a $2 million injection into the wealth or investment portfolio from the sale of the business. And it's pretty certain right now that that's not going to happen. There's going to be nowhere near this $2 million number that's going to be entering into the picture to help this person with their retirement. So, what can we learn from this story, and how can it help you and business owners and financial planners out there? Well, the problem is that we've got guesswork value for something that is probably a major chunk of the business owner's overall investment portfolio. I made a video a couple of weeks ago. We'll put a link to it up above here, that where I talked about the kinds of things that I've seen successful entrepreneurs invest in. And if you look at the portfolio value of a business owner, from the point of view of a financial planner, for example, they're going to have different investments, mutual funds, stocks, bonds, whatever it is. Almost all of this stuff is going to have a reported value that can be validated by a market, right? So stocks of Coca-Cola are going up and down. We know what the stock market price is. And so over the course of time, as the entrepreneur gets older and they keep meeting with the financial advisor and they keep updating the plan, it moves from the world of projected kind of estimates and guesswork into the past where it's actually recorded actual performance. So if the investments do better, then the financial advisor might suggest a less risky asset allocation, for example, because not as much growth is needed. So let's be more cautious, for example. Or maybe other things are determined, like maybe we'll take some money out for some reason, or you don't have to put as much in this year, or whatever it is, right? And so all of these sort of fine tuning adjustments are being made, but one of the biggest aspects of that person's portfolio does not have a market mechanism for determining its value, and that is the business itself. So we want to move away from having this exposure to guesswork into having a more formidable and reliable financial plan for an entrepreneur to plan their retirement as they move through the years, right? So what is the solution then? Well, you can actually have a business evaluated to figure out what it might sell for. And where people are getting into trouble is that they're using one number, and then as they actually approach retirement, they're then meeting with someone who can help give them a value on their business, like a business broker or someone like myself. And then they're being told this is what your business will likely sell for, and then they're all of a sudden they're finding this huge discrepancy between the guesswork number they were using and the actual value. So all you have to do is apply the same thinking that you do with the other investments. Let's have a more up-to-date value. So here, let me share my screen because I want to show you guys something. So this is a website that I own. This is howtosellmyownbusiness.com. And I'll put it up here on the screen. Howtosellmyownbusiness.com. It's got the same name as a book that I wrote all about how people can sell their own business. So on this page, there's a welcome message from me. There's some basic information there. Some stuff about before you sell your business. There's what we call step one, which is information and learning for business owners about the process of selling a business. And then you get down here to step two, pricing guidance. So normally when I'm working with someone helping them sell a business, they'll go through these steps, and we'll do the pricing guidance, and then we'll do the buyer readiness, which is to create the buyer facing package of documentation, the business profile or the SIM. And then maybe we'll do an advertising program where we advertise the business and confidentially, and we filter the inquiries that people send in on the business for sale. And then we have guidance, coaching, etc., that we help people with. But we're just going to look at step number two. So step number two is the pricing guidance. It's what we call the most probable selling price evaluation. And there's a video here that you can watch, which explains step by step, like how we go through this process and what the final report looks like. So let me tell you what many of my clients are doing. Okay. So what they're doing is, instead of waiting until they want to sell the business to do the evaluation, they're doing the evaluation, many years earlier. And then each year or every second year, when they get their new financial statements updated, they send them in to us and we update the report. And so what it does is it removes the guesswork from this whole process. It actually shows them what their business is likely going to sell for and creates almost like a benchmark or a scorecard for their business because they can then see what their business's value is. And it can inform much more than simply the retirement plan of the business owner. What it can do is it can help you make decisions about things like whether you should reinvest in the business by buying new expensive capital assets like big pieces of machinery, or if it makes sense to increase inventory levels. All kinds of stuff can be determined or better decided with this sort of information. So, that's a process. The initial one costs, it's going to be a couple grand. That like reach out to me if you want to know what the real pricing is. But once the initial one is done, the updates are relatively cheap. So, what is the alternative to that? Is there something between having me and my team do an MPSP evaluation and guessing? Well, there is, but you got to take them all with a grain of salt. So, for example, you could rely upon like something that comes out of some of these online business value calculators. Mike Finger, who's been on the show before, and I were having a chat the other day about some of these online calculators. He sent me some URLs, some links to some of these things, and some of them are presented as though they are small business value calculators, but they ask questions such as the rate of growth, which mean to me that they're tied into valuation methodologies that are actually used for evaluating publicly traded stocks, where they're using discounted future cash flows as a valuation methodology for determining the value of a small business, which is a completely inappropriate methodology for a small business. What what's the difference? Well, in publicly traded stocks, you look at growth rates because the management leadership team of the company is there, and when you buy the stock, they remain there and they execute their plan. So you're buying into the leadership team as much as you're buying into the company. Whereas with small businesses, the leadership brain trust usually departs when the business is sold. And so buyers don't typically look at future discounted cash flows. They see the future growth and profitability as the work they will do that they are entitled to have as a gain. What they would do instead is they value the business based on your historical cash flows and under the assumption that they'll be able to carry on those cash flows under their stewardship, right? And if they don't think they can, then they're going to want to discount it, and they're going to want different terms and all that kind of stuff. But be careful with those online calculators because they may have huge numbers of assumptions under them that can make them just as bad as guessing, right? The other issue is that you want to make sure that whatever value you're using is actually based on something that could be obtained in the market. So, for example, I've said many times that when most people find out what their business will sell for, they are kind of, disgusted with the number because small businesses are sold at very low multiples of cash flow. And most of them will say, why would I sell my business for that amount of money? I can just keep the business for the next few years. I'd earn that money myself and then I'd still own the business. And they would be correct. So when you get a business valued, you can get all kinds of different flavors of valuation. Some are used in, marriage breakdowns like divorce court. Some are used for, tax issues. The purpose of the evaluation is really important in determining what the outcome actually is, what the number is. Like, and so you want to make sure that the evaluation that you're working with is actually based upon selling the business to someone else who's going to pay money, and you want to have an idea of what the terms are likely going to be, right? Which is another thing that I mentioned to this financial planner I was talking to, because not only were they using an assumption about the value of the business, they were assuming that it was going to come in one check, right? Which is not how most businesses are sold. Most businesses are sold with some degree of seller financing, which means that not only do you want to have an idea of what the value is, but the minute that transaction occurs, all of a sudden the the business owner or entrepreneur's portfolio is no longer going to be composed of, investments they've made and the business. Is going to be composed of investments they've made and this note, which, now is another different kind of asset more of a fixed income asset, but it certainly doesn't have the same kind of risk profile as like a government bond, right? So all of these things need to be considered as you move along here. So, um, great comment that I heard on another podcast the other day is somebody said that it takes years to build a good business, but you can wreck one in 90 days. And um, this is why I think it's really important that you do this regular updated valuation of a small business for retirement planning. Um, because if you are, let's say you do a valuation in your mid 30s and they find out that your business is worth $1 million. Okay. As you get older, things completely outside your control can have an impact on that business and cause its value to go down. If you know that the value is going down over the course of time, then just like with any other investment, you can modify your plan. You can say, all right, I need now to invest more, or I need to invest more aggressively. I need a different kind of plan, etc., so that you end up at the end of the day with a retirement that you can rely upon. Because in the conversation that I had the other day with that particular financial planner, when we were discussing their client's case, um, the planner at one point said, oh, well, it doesn't make sense for them to sell then. You know, like if they're not going to get a value that is much greater than the value of the inventory, why would they do the deal? And they're not going to end up with enough money for their plan to come to fruition for them to have the retirement that they wanted. And I said, yeah, I said, that's totally what happens. That happens every time. When somebody makes an error, for example, in calculating the value of their business, if they think they have a $2 million business, but no one's willing to pay them more than like 700 grand for it, for example. And if I ever meet those people and I look at whatever their business is and I say, yeah, this is why, because it really is only worth, this amount of money. The normal response is not, gee shucks, I guess then I'll have to accept the fair value. The response is always, well, that's not enough money for me to retire on. I guess I'm going to have to stay in the business. And this is how you get, business owners in their 70s still running their business when they want to be retired. It's because the plan failed because they were using assumptions in the plan that didn't hold true, and they never tested their assumptions as they move forward through time to get to the end. So let me just take a quick look at my notes here. Um, okay. So not only does the financial planner need to have someone evaluate the business as throughout the working ownership career of the owner, the financial planner needs to be part of understanding the valuation. So what do I mean by that? Well, for example, we could do an evaluation on a business. We could produce an MPSP that says the business is worth $2 million. And here's the likely selling scenario. Here's likely how much seller financing this owner may have to provide, et cetera, et cetera. So we can create that, but then within that plan or within that valuation, there's going to be other things in there. For example, the value of inventory, the value of capital equipment, the tangible asset value. So while a business can be ruined by 90 days of poor decision making, the breakup value or the liquidation value of the business is going to be a little bit more resilient than that. So it's important to know because there's the value of the business today, and then there's the potential value if everything goes wrong and we have to close the business, which may not be zero, right? It could be a higher number. So the different values that could be part of the conversation could have different varying degrees of confidence attached to them, which is going to be valuable for a financial planner to know. So, if, for example, we know that the business today is worth about $2 million and it might be sold realistically with 70% cash on closing and a 30% seller note held over 5 to 8 years, for example, but that the business contains, $1.2 million of tangible assets that may be able to be realized in some kind of quick closure or liquidation scenario, it means that the financial planner can say, okay, the business is likely going to be worth more than 1.2. It may be worth 2 million, but I can depend more on that lower number, right? And maybe we make two plans, like a realistic or a pessimistic and an optimistic plan with these two different numbers so that we can see what the outcomes are likely going to be under either scenario. Now, doesn't that sound like a much more durable or robust way to think about getting yourself to retirement? I think so, right? So, um, the benefits of doing a regular business evaluation allows for realistic planning, as I've just covered. Um, Adaptability, it allows for the business owner to make better decisions about things in the business, such as reinvestment in new equipment or inventory, things like that, as I've mentioned. Enhanced credibility, so you can just have more confidence in the plan. Um, and how can we help you? Well, we do these. So like I said, head over to howtosellmyownbusiness.com if you want to watch that video, and then reach out to us, and we'd be more than happy to answer your questions. We work with people all over the place to do these evaluations. Um, I think that if you are a business owner, your focus, your area of expertise, obviously, is on running the business, right? And if you are in a fortunate enough position to be, to have a business that is putting out excess cash that isn't required in your business for its continued growth or renewal of equipment or whatever, and you are accumulating this wealth into some kind of investment strategy, then obviously it makes sense to be working with someone who helps you with the financial plan, right? And so if they're going to be able to do their job correctly, if they're going to be able to advise you correctly, um, knowing what the business is worth and what it might be sold for is definitely a part of this whole equation that I hate to see you, just rely on a guess. Anyway, that's today's message. And if you're a owner out there, please think a little bit about it. And if you're a financial planner or whatnot out there, or an investment advisor, and you're working with someone and you realize you've got one of these sort of black hole assumptions that may be a very significant portion of someone's financial plan, then maybe it makes sense to encourage them to get the business valued so that you're not working with a blindfold on. And with that, I'll say see you later. And we'll talk to you next time.
So, how can you learn more about buying, selling, financing, and managing small and medium sized businesses? Easy. Go over to my blog site, davidcbarnett.com, where you can learn more about me and how I work with my clients. You can learn more about my books and courses that I prepared for you. You can find out how to subscribe to my email list, the YouTube playlists, and more. There's literally hundreds of hours of content there, all for free, and I'd love for you to be my guest. Special thanks go to Mark Willis at Lake Growth Financial, today's video sponsor. Mark helps people better manage their personal and business finances through the Bank on Yourself insurance strategy. This is something I've done personally and I've seen others use it successfully for years. Go to newbankingsolution.com to find all the interviews I've done with Mark and learn more about the advantages of these programs. While there, sign up for a free consultation to learn what this solution might look like for you.